Hey everyone, I'm Gary Szafron. This is Kitco News. Don't forget to hit that subscribe button for all the latest. Now today on Chart Case with Gary Wagner, we've seen a significant sell-off in gold recently, and it seems like we're in the midst of a week-long consolidation phase. So here to explain what this consolidation could mean for gold prices and of course what's behind it from a technical analysis perspective, let's welcome back our buddy Gary Wagner, our resident technical analyst, joining us from Hawaii. Always good to see you, Gary. Welcome back.
Thanks so much for having me, and it is great to be back for our viewers, especially on a Friday.
Yeah, absolutely. Isn't that the case? Okay, well, lots to get to. It's been a crazy week. We won't even touch on some of the news flow, but let's pull up some of that gold charts. I mean, you know, today we're witnessing a sell-off in the gold market. And like I said, Gary, it almost seemed like it was a week-long consolidation phase. I know we talked, you see a head and shoulders pattern here. Talk to me about it, what you're seeing and what your price predictions are in the context of this recent, crazy market behavior on the gold side.
Oh, absolutely. We'll look at a couple of charts, a short-term view as well as a longer-term view. The first one we're looking at is a short-term view. We're looking at the compression triangle that we talked about last time we were on, which is created simply from a series of lower highs and equal bottoms. A flat bottom, you've got equal lows, but descending top, and that is because you've had a series of lower highs. And so what happened is we saw that there was a real possibility last time we talked that if gold broke through this upper level resistance line created as a trend line from the lower highs, then we could get a sizable breakout to the upside. And the way I like to explain it is it's kind of like tightening a spring. Every time gold trades to a top and then moves back to the bottom, it kind of tightens that spring up. Then it goes to the top, but doesn't break through. It tightens it a little bit more, tightens it on this last one. And so when it does break through the resistance line, it can do it with an extreme amount of power. In this case, it was kind of a tepid move. It moved for 2 days and then moved sideways. What we are witnessing now was when you consider that the low that came in on this compression triangle or descending top flat bottom was from 2,300 to 2,488. So we're talking about a move of roughly $188. That's a respectable rally for gold. That coupled with the fact that it hit a very strong, even psychological number, 2,500, it found resistance there. And the absolute top of the market occurred a couple of days ago, but that was also the day that gold futures traded to the highest intraday value in history, which is 2,488. So what we witnessed through the week has been, I believe, profit taking, and it is a correction. So the question is, will this be a shallow or deep correction? Because what you see in blue to the right of these lines are based on a Fibonacci retracement or a retracement set. So we start at 2,308, we go up to 2,488 and a 50% retracement. In other words, if it gave back 50% of the rise, that would have taken it to about 2,400. And that's kind of where we're at because we're at 2,401. So the question is, will it find support at this level? If not, it most likely will trade lower to the 50-day simple moving average, which also corresponds to the 61.8% fib retracement at approximately 2375.
Okay. So these are healthy profit taking levels here, Gary. It was kind of anticipated. I know that head and shoulders patterns can sometimes lead to false signals, especially during consolidation periods. So, what other indicators are you looking here, and what do you rely on in terms of this analysis? If it's just, some healthy profit taking, hopefully we're going to see these levels continue to beat that resistance.
Well, no pattern is 100% guaranteed. Yeah. No technique will always work. In the case of my analysis, I combined Japanese candlestick pattern recognition, standard Western chart pattern recognition, along with Elliott wave theory, and then lastly, Fibonacci retracements and extensions. So what we're witnessing is really the fact that if a market trades from $1 to $2 and then corrects or sells off to $1.50, it still took 2 steps forward and only 1 step back. In other words, when we watch a market, unless it's parabolic, it does move up in a stair-step manner, meaning it has a surge in price, it gives back some, it goes into another rally or wave, so another surge, and then it gives back less. As long as it gives back less than it accumulated on the way up, it's still considered to be have bullish market sentiment.
Yeah, great. I mean, a lot of people saying that this was just a little bit unexpected today, but of course, you know, your charts highlighted those key support levels at around $21.80, $2,300. Talk to me a little bit and explain to the audience why these support levels are so critical here, and you know, how are they going to affect this short-term outlook while we're consolidating?
Okay. Well, I would label this a correction and not a consolidation. Typically, a consolidation, it's moving sideways.
Mm-hmm.
When we look and use all of these technical tools, you'd use them mostly for entry, exit, timing, but you follow the fundamentals of the market. So when we look back to what occurred on Monday, that really was that last feather in the cap of the rally. Powell came out talking at the Economic Club of Washington. And when asked about a September rate cut, in fact, any Fed member, when asked about the timing of a rate cut, would simply push that off. Powell's language was that we're focusing on getting inflation down to a 2% target. We're not there yet, and we need greater confidence, always put in quotation marks, and that greater confidence comes from more data, which simply means more reports lending evidence to the fact that inflation continues to tick down. Now, prior to him speaking, the last inflation report that came out showed a consistent trend of 3 months, consecutive 3 months with lower inflation prints. And so for the first time when asked about a September rate cut, he said, I'm not going to address the timing, but we will cut rates before they hit the 2%, before inflation hits its 2% target. And so in Powell speak, in Fed speak, that's a clear indication that they're planning on initiating the first rate cut since they started raising rates in March of 2022 and beginning a process of interest rate normalization. In other words, it's the first rate cut is exceedingly important, but then we have to go back to the dot plot. The most recent one is in June, and the most recent dot plot, which takes the 19 members that are at the meeting and has them vote on the likelihood of where inflation will go, where interest rates will be, and what the GDP of the economy is. And in March, they were anticipating that they would cut rates 3 times by 0.25%. In June, they revised that to 2 times by 0.25%. So the fact that he opened the door to a September rate cut is really what created the last moves in gold, and it found resistance at 2,500. Anytime any stock or commodity goes to an all-time record high, it typically meets resistance, backs off, even if it's still in a bullish momentum. And that's what we're seeing with gold.
Right. You know, it's interesting. I mean, you've talked to different analysts. We've been talking about it throughout the year, seeing here, where is this outlook? What are we going to hit by the early 2025? Now, talk to me a little bit about your prediction here, because you talked about a potential rise to about 2,700 by early 2025. And correct me if I'm wrong, Gary, it's based on the Elliott wave analysis. Let's talk about this.
Yeah, I've just put up are longer term projections. And what we're using here is the combination I just spoke of. What I find most interesting is that this is the second occurrence of a descending top flat bottom, a compression triangle, which is a way to define a correction. There's two basic groups that they come in, although there is a lot of nuances to those groups. But what we call a simple zigzag means that it goes from $1 to $1.50, down to $1.25, and then to $1.75. In other words, you get a zigzag like you get from this low to what I'm labeling as 1 to the conclusion of the correction. The other way is you get a series of typically lower highs and higher lows. In other words, you have a triangle on both sides. So what we're looking at is we now have what I'm labeling as a wave 1 on our Elliott wave count after finishing a correction with the conclusion of the fifth wave occurring back on Friday, the 17th of May. And that's when it hit the second of new all-time record highs. It then would correct over a period of a couple of months. It broke out, and that was the last time we talked. It definitely found resistance. It's come down the remainder of the week by 50%. If it holds here, that's one thing. If gold continues to trade under pressure at the beginning of next week, I don't think it would have far to go. As I said, my target would be around 23.75. That's a 61.8% retracement of the rally up. And from there, you go into a third wave. Basically, an Elliott wave, it is based upon a 8-wave cycle, of which the first 5 waves are what's called the motive phase, which will typically include on a bullish count 3 waves that are strong rallies, in other words, price gains. In between them, wave 2 and 4 will be the corrective wave. So you get wave 1, wave 2, wave 1, wave 2, wave 3, wave 4, and wave 5. So this model is taking a lot of flexibility inherently as we get out in time. But if gold does find support either at current pricing, right at around 2,400, or a little deeper to 23.75, it would move at least equivalent to what we saw during what we're labeling as the first part of this rally, or wave 1. In other words, from 24, we would move back to about 25.80 or 88. A really bullish rally would take it to 26, and as high as just shy of 2,700. And this model is a long-term model. I wouldn't expect it to reach any of those peaks till the end of this year, first quarter of next year.
Okay, interesting. I mean, it's certainly, gold has been on the move. I mean, Gary, you and I, when we started talking back in January, we were getting past that $2,000 level. We were almost in misbelief. I guess as we sit here and debate, these levels sitting here around 2,500, 2,400, it seems to be a new normal. I mean, people are taking healthy profits at this level. I guess that's what this looks like.
Well, we are seeing healthy profits, and that's because we had a sizable move. And that goes back to really the question you just asked, and why has gold moved in such a spectacular manner and gained so much value in such a short period of time? And to me, the answer is, at least on the peripherals, is fairly simple. Gold, the precious metals to us, are paired against dollars. As long as the government creates a larger debt, in other words, the fiscal deficit continues to widen, we have more debt, it can't support the dollar. The dollar is going to lose value against the currencies that it's weighted against in the case of the dollar index. But when you have countries globally practicing an economic approach that says when you get into trouble, if you have a recession, print more money, stimulate the economy, and that does get the juices flowing. It does create a larger GDP for that country, but it also creates more debt. And if you have more debt, that's going to pressure that currency. In the case of what we're discussing, that's what has been really moving the dollar lower from recent highs at around 106 to just below 103, a 3% drop in a short period of time. So that is a very large factor of why gold has had a stellar performance.
Yeah, it's been fascinating. Of course, we'll continue to watch this move and all the latest news and get you on, Gary. Gary Wagner, our technical analyst, breaking it all down. $2,700 gold by Q1, Q2 of 2025. You heard it here. Thanks, Gary. Appreciate your time.
Thanks for having me. Bye-bye.
Thanks. Thank you. And thank you again for tuning in. Of course, for all of us here at Kitco News, I'm Jeremy Szafron. Thanks for watching. Don't forget to hit that subscribe button. We've got great content coming up this week. We'll see you next time.